Is Coca-Cola, ticker symbol KO, a good stock to buy now? Welcome to Global Value. Today, we're performing a fundamental analysis of Coca-Cola using Warren Buffett's investing framework. It's one of his top investments for more than 30 years. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Coke is worth in today's stock market. Plus, I'll share a special bonus that could be the deciding safety factor when adding Coca-Cola stock to your portfolio. Right now, Coca-Cola trades for $67.05 per share. In its last day of trading, it's up 1.48%. Since July of 2023, Coca-Cola is up 6.2%. The company's stock price has lagged the S&P 500, which is up more than 20% at the same time. In the last 5 years, they're only compounding at 3.7% annually. In the last decade, this is 4.7% annually. They're behind the market since 2017. When we go back before the global financial crisis, in the last 2 decades, Coca-Cola was beating the market up until around 2017. Over this time, they've compounded at 5.8% annually. Still, these aren't the only returns for shareholders. Right now, Coca-Cola pays a market-beating 2.9% dividend yield. They're a dividend king who's grown their dividends 62 years in a row. When they're added back to their stock, Coke has actually beat the market for much of this time. Today, Coca-Cola trades right around its 52-week high. This is up $16 from their 52-week low. As one of the biggest companies in the world, Coca-Cola has a $284 billion market cap. Right now, there are 7 super investors who own Coca-Cola. This is led by Warren Buffett, who has 7.4% of his portfolio in Coke's the company. Been a Buffett holding since 1988, when he put 25% of Berkshire's net worth in the company. Starting with our first metric, we want Coca-Cola's average returns on capital to be above 14%. These returns tell us how much value the company's creating. For a business like Coca-Cola, they've been very steady and very stable for a long time. In all 5 of these years, they're above that benchmark, and they've been getting better since 2020. Coke earned nearly 18% returns on capital in 2023, and in an average year over this time, they earn around 16%. It's great these returns are both steady and high. It's a check on our first metric. Now, why don't we learn more about the business? Founded in 1886, Atlanta headquartered Coca-Cola is the world's largest non-alcoholic beverage company. Its strong portfolio of 200 brands covers key categories including carbonated soft drinks, water, sports, energy, juice, and coffee. Together with bottlers and distribution partners, the company sells finished beverage products bearing Coca-Cola and licensed brands through retailers and food service locations in more than 200 countries globally. Coke generates around 2/3 of its total sales overseas, with a significant portion coming from emerging economies in Latin America and Asia Pacific. Now in metric number 2, we want to see if they grow to support their high returns. Here we want sales, earnings, and free cash flow growth. As a business, Coke is a slow and steady grower. From 2019 until today, their sales are up 23%. Their earnings are up 21%, and their cash flows are up 19%. This is steady and reliable growth with stable and high returns on capital. It's another check on our second metric. Next, we want to look at Coke from the view of an individual shareholder. In metric number 3, we want earnings per share growth. Coke has grown their earnings over this time and they kept their shares around flat. This means that their earnings per share are up. They earned $2.47 in 2023, and in their last 12 months, they brought in $2.49. Another check on metric number 3, and Coca-Cola is perfect so far. Metric 4 is similar but even more important. We want free cash flow per share growth. Coke has again grown their cash flows over this time, and with flat shares, their cash flows per share are up. It's another check. Coke is still perfect. And now, before we look at the company's balance sheet, it's time to check in on their dividends. Right now, Coca-Cola is a dividend king, growing their dividends 62 years in a row and paying a 2.9% shareholder yield. Last year, they grew their dividend 5%, but is it safe and can it keep growing? In our dividend bonus, we want them to be supported by their cash flows. This has been the case for Coke in all of the last 5 years, and it's also the case today. The company is very asset light, and they pay out most of their cash flows as dividends to shareholders. Still though, they solidly support these, and it's a check on our first bonus. Next, Warren Buffett says wonderful companies can grow, earn high returns, and don't need a lot of debt. Coke is no different. They ended 2023 with just over $30 billion worth. Today, they only have $26.8 billion of net debt. At the same time, Coke's brought in $47.6 billion of free cash flow. That easily and comfortably supports their debt loads. It's exactly what we wanted to see, and it's another check here on metric number 5. Does Coca-Cola have what it takes to be a perfect Select 6 stock? Before we find out, we need to cover our safety bonus. If you're picking stocks, Warren Buffett's teacher Ben Graham wanted to see a current ratio greater than 1.5 times. This is a key measure of short-term liquidity for how a company can pay its bills in a hurry. In each of the last 5 years, Coca-Cola hasn't been at this mark, and this is one of the only blemishes against them. Instead, their current ratio hovers just above 1 today, and it means this is an X on our safety bonus. Now, given Coca-Cola's asset-light and highly cash flow generative nature, it's likely not an issue for the company, but it's still something to keep in mind and look at. Now, how much is Coca-Cola really worth? The big metric of them all, metric number 6, is also our first valuation. We want Coke's average cash flows divided by their enterprise value to give us a yield that's greater than 5%. This is in line with the history of the S&P 500, and it would give a slight risk premium to the 10-year treasury. Coke today has a $311 billion enterprise value when we add their market cap and their net debt together. This helps us look at the company like it's a private business. In an average year over this time, Coke brings in around $9.5 billion of cash flows. This means when we divide it by their enterprise value, it only gives us around a 3% yield today. Even if we take their highest cash flows over this time and project them into the future, they only bring in a 3.2% current yield. Even though Coke is a wonderful company, that's lower than the benchmark we wanted. It's our first and only X of the day outside of their bonus against Coca-Cola. However, don't throw this business out. We still have 2 more valuations to look at before we put them together for their fair value at the end of the video. Plus, there are some special things about Coca-Cola that Warren Buffett loves outside of their numbers. Let's give Coca-Cola credit for its growth too. Here we're using a discounted cash flow model. We'll start with an average of their cash flows, then take historical assumptions to grow them into the future. Let's assume they grow their average cash flows at 5% for every year in the next decade. Then in the following decade, we'll assume these grow at 4%. Buffett typically wants a 15% rate of return. Keep in mind he hasn't invested in Coke since the early 90s, but he still held on. Today, if we want that same market-beating 15% rate of return, then it looks like a fair value for Coke based on this DCF is only around $20 per share. Today and in the last 10 years, Coke has traded for 27 times earnings. It's hard to outperform when that's double the average of the market historically. So why did Buffett hold on? He's publicly said that it was probably a mistake not to sell the business during the dot-com bubble in the late 90s. Indeed, since then, Coca-Cola has underperformed the market. Still, Coca-Cola is a wonderful business, and Charlie Munger said it has the widest moat in the world. That's part of why our third valuation comes in at $67 per share, just about their current stock price. Now, Warren Buffett likes the numbers, but it's the qualities of a company that are his true love. Why don't we learn what these are for Coca-Cola through a long and a short thesis and see why both him and Munger love the company. Number 1, Coke can leverage strong bottler relationships in underpenetrated emerging markets to drive volume growth. To do this, they can use classic recipes as well as new products tailored to local tastes. Number 2, heavy investments in digitalized supply chain and data analytics have better aligned Coke and its bottlers in product planning, manufacturing, and go-to-market strategy. Number 3, as Costa recovers from the pandemic-related disruptions, it should help Coca-Cola gain a firmer footing in the coffee category. This would provide more consumer insights given its global footprint. Yet things aren't all positive for Coca-Cola. Let's look at a short thesis as well. Number 1, secular headwinds in carbonated soft drink demand in developed markets are a challenge to Coca-Cola's long-term growth outlook. Number 2, the company's brand portfolio and product lineup in non-sparkling categories are less robust. Heavy investments are needed to bolster its competitive position. Number 3, with 2/3 of revenue from international markets, Coke constantly faces currency fluctuations that drive volatilities in reported earnings. Now let's put everything together for Coca-Cola. In our fundamental review, we learned they go 5 for 6 on the Select 6 analysis. They earn high returns, but they've been a slow, steady, sleepy grower for nearly 2 decades. The company's very asset light, and it does a good job of both generating a lot of free cash flow and giving a lot of this back to shareholders as dividends. Even as a wonderful company, still based on today's higher valuations and lower growth assumptions for the future, it doesn't look like Coca-Cola quite makes the cut. Remember, this isn't financial advice. When we look at their fair value through our investing tools, this only comes in around $52 per share. That's near their 52-week low, and it's $16 below their current stock price. Today, Coca-Cola looks overvalued. Interested in finding stocks that are undervalued? Sign up for our investing tools and get exclusive bonus coverage of 104 stocks and counting.